Have you ever seen a company report just amazing earnings, blow past all expectations, and then you watch its stock go on this wild roller coaster ride? Well, that is exactly the puzzle we're going to unpack today with PDD Holdings, the parent company of Temu and Pinduoduo. Okay, let's just dive right in.
So, here's the big mystery. PDD absolutely smashed its Q2 2025 earnings. That led to this massive jump in pre-market trading. But by the time the closing bell rang, all that excitement had just fizzled out, leaving only a tiny gain. So what on earth happened? Why did the market get so spooked by what looked like fantastic news? We are going to break it all down. But first, to really understand the drama, we need to meet the players. So let's get to know PDD Holdings and its two powerhouse platforms that are totally shaking up global e-commerce. Okay, so PDD Holdings is the big umbrella company here. It was founded back in 2015, and since then it's just exploded into this massive multinational commerce group. And while its roots are still super deep in China, its headquarters are now in Dublin, Ireland, which really tells you everything you need to know about its global ambitions. PDD operates with this really fascinating two-pronged attack. On one side, you've got Pinduoduo, its flagship in China. It's the one that pioneered social shopping and group buying, and it is a total cash cow. Ad revenue alone jumped 13% year over year. And then you have Temu, the global disruptor. That's the overseas arm that has taken the world by storm with its crazy low direct from the factory prices. So two very different strategies, all under one roof.
All right, so with that context, let's get to the numbers that caused all that initial excitement, because PDD's Q2 2025 earnings report looked, at least on the surface, like a massive, massive win.
The headline number was just huge. The company pulled in nearly 104 billion yuan in revenue for the second quarter. Now, this blew past what analysts were expecting, and it signaled that the demand for its discount model is incredibly strong even when the economy is kind of tough.
And the good news didn't stop there. The adjusted earnings per share, or EPS, didn't just beat expectations. It absolutely crushed them. It came in over 40% higher than what most analysts had predicted. I mean, that points to some serious operational efficiency. But when you look at the full financial picture, well, it tells a more complicated story. Revenue was up, yeah, and the company is sitting on a massive pile of cash. But there's a problem area. Look closer at that operating profit. Down 21%. That is the first major crack in the good news story, and it's where our mystery really starts to unravel.
So we've got a huge revenue beat on one hand, and a pretty steep profit drop on the other. This right here is the pivot point. Let's dig into the real story behind these numbers and figure out exactly why the market celebration was so short-lived.
The stock's performance that day really tells the whole story. I mean, look at this. It shot up 12% in pre-market trading when those headline numbers came out. But as investors and analysts started digging into the report and listening to the earnings call, all that optimism just evaporated, leaving just a tiny 1 to 3% gain. Why the dramatic reversal? And here it is. This is the smoking gun, and it came directly from PDD's own management. They basically told the market, hey, don't get used to this. This single sentence was a huge signal that the company is prioritizing heavy investment and long-term growth over consistent short-term profits. And for a lot of investors, that was a major red flag. So the key thing to understand is that this wasn't just about one thing. It was a perfect storm of 4 key factors that created all of this volatility. We're going to walk through each one. The profit reality check, the intense competition, those rising costs, and the broader economic factors at play. First up, that profit reality check. That 21% drop in operating profit, that wasn't an accident. It was a choice. PDD is pouring billions into things like merchant support programs. They are sacrificing today's margins in the hope that it'll secure them long-term market dominance. And while investors love growth, they get really nervous when it comes at such a high cost to profitability. And this isn't some bizarre one-off event. Just think about what happened with John Deere not too long ago. They beat their earnings estimates, but their stock totally tanked, all because they issued a weaker forecast for the future. It just proves a powerful rule of the market. A cautious outlook can completely overshadow a great quarter.
Next up, the absolute battlefield that is e-commerce. In China, PDD is stuck in a brutal price war with heavyweights like Alibaba and JD.com. And then globally, Temu is fighting for every single customer against giants like Amazon and Shein. On top of all that, you have this looming threat of US policy changes that could slap tariffs on Temu, which would jeopardize its entire low-cost business model. Okay, let's talk costs, because these numbers are startling.
While their sales and marketing expenses stayed pretty steady, the cost of revenues just ballooned by 36%. Now, this category includes all the essential stuff like order fulfillment, payment processing, server costs. It just shows how incredibly expensive PDD's growth and global expansion really are.
And finally, you have to zoom out. PDD doesn't operate in a vacuum, right? US-China trade tensions create this constant uncertainty, and in its home market in China, retail sales are growing at a really sluggish pace, which means all these e-commerce platforms have to fight way harder for a smaller piece of the pie. All these external pressures just add to investor anxiety.
So after all of that, what's the big takeaway here? I mean, whether you're an investor or you're just trying to make sense of the market, what does this story of PD's wild ride really mean for you?
Well, the key takeaway is to look past the single-day drama. This whole event is a great reminder to diversify, to focus on long-term stuff like user growth, not just quarterly profit, and to stay on top of regulatory risks like tariffs. But most importantly, it means understanding PDD's core strategy. They are playing the long game, even if it causes some short-term pain.
And they definitely have the resources to do it. This is PDD's safety net. They have a war chest of over 387 billion yuan in cash. That gives the company a massive buffer to fund all these ambitious investments in tech, logistics, and merchant support for years and years to come.
So what do the experts think? Well, it's a bit of a mixed bag, which kind of reflects the uncertainty we've been talking about. You see some neutral and hold ratings out there, but the consensus on platforms like Seeking Alpha is still a buy. It just shows that while there are definitely immediate concerns, many still believe in the company's long-term potential.
Which brings us to the final question. Is PDD's strategy a super risky bet on future dominance that just might not pay off? Or is all this volatility simply the price you have to pay for a ticket on a long-term growth story? The answer, really, depends entirely on whether you prioritize today's profits or tomorrow's potential.